In today's video, we'll look at how to read a balance sheet of a company. So what are the different components in a balance sheet? And also we'll look at the income statement for a company. And also we'll look at the different financial ratios. And why do we calculate those financial ratios? How that would be helpful to for the companies to take financial decisions to improve the overall financial strength of a company. So what I've done is based on the knowledge I got from building the balance sheet of for a company, I've utilized the same principles to build my own balance sheet for my personal life. So we'll go through that, how you can leverage this to understand your net worth probably, and how you can track your income on a month and take decisions to improve your overall financial status in your life. So before we get any time wasted, let's get started. So for any balance sheet, there are generally three components. One is assets, liabilities, and shareholder equity. So assets comprises of current assets and other assets. So what do we mean by current asset? Anything that you hold as cash or any money that has to come into the company. Like for example, you have sold a product you have made, the company has made, and that for that product, the supplier has to pay back. That is called as account receivable, and all the different inventory of the products that we are holding within the company is called inventory. And against those, these are the values. So we're saying for this particular company, they have cash and cash equivalents of 10 million, and 1.5 million has to be received from their customer, and they hold an inventory of 700,000 pounds. So these are called current assets. Even within this current asset, some can be liquidated quickly. If we say cash, which is pretty much we have the ready-made cash in the bank or hand that you can utilize immediately. Accounts receivable and inventory would take little bit time to liquidate. Let's say if you want to get cash out of your inventory, you cannot immediately turn that into a cash. So you have to sell all the inventory to realize this 700,000 pound as cash. So adding up all these three would be your total current asset. So other asset is something which you have as kind of property or a plant or equivalent, which is more like a long-term asset of which you hold, which is of 2 million for this company. So if we take the total asset for the company to both total current asset and other assets, it is 14.2 million. So this is something what you own, what you have, which you can convert into cash. That is your asset. Now what is liabilities are first is accounts payable. So any money that you owe to a supplier, supplier might be sending you multiple material for you to make the product. For the materials you buy, if you have to pay back to the supplier, and that is the accounts payable. So that is 1.5 million for this particular company. And accrued expense is more like, see these ones, you would get an invoice. Already you've got an invoice. So you know that 1.5 million, you have to pay to vendor. But still there are certain items you would have bought from a vendor, but you have not got an invoice yet. But still you're liable to pay back that money back to the vendor. That is called accrued expense, which is 200,000. And deferred revenue is sometimes what you get from your customer is they'll pay in advance till you would have not made the product. So until you have not delivered the product, you're still liable to pay back that money what you got from your customer, and that is called as deferred revenue, which is 100,000. So total current liabilities is 1.8 million, adding these three up together. And non-current liabilities are your long-term debt, which is more like a long-term loan which you've got for a company. That is considered as non-current liabilities. Total value of 3 million for this company. Your total liability is 4.8 million. So shareholder equity is, so shareholders are the owners of the, pretty much the owner of the company, equity owner of the company. And what is the shareholder equity is calculated by total asset minus total liabilities, which is 9.4 million. That is 4.2 million minus 4.8 billion. I hope that is clear so far. So what is the income statement? So income statement is nothing but like, on a month-on-month or a day-to-day basis, okay, what is the amount of product you're selling and how much it costs for you to to make that product, and what is your operating expense to make that, what are the different expense you have in terms of admin cost or general cost or R&D cost or marketing cost. So those are will come as part of the income statement. So to just go in a proper way, the first is sales. Okay, the amount of sales you have done in the year to 2021 to 2022, the company, which is 15 million. How much it has costed for them to make those sales, to build those products and sell them, costed them 13 million. Now, the gross profit is the profit before the expense, okay, and the taxes, okay, which is total sales minus cost is total cost of revenue, which is 15 million minus 13 million, which is 2 million. Now, the operating expense are the expenses, okay, the company bears, to run the company, to build those products and to sell them. So it is more like general selling and admin kind of expense, office expense, R&D expense, sales and marketing expense. So in this case, the general admin is 100K for the year. R&D is, they don't do any R&D for the product they build, so it is £0. It costs them $500,000, that is 500,000 to as part of the sales and marketing expense. So now the total operating expenses, by adding all of this, you would get that, which is 600,000. So now, what is the earning before interest, tax, depreciation, and amortization? So that is your gross profit minus your operating expense is the EBITDA, which is earning before interest, tax, depreciation, and amortization. That is 2 million minus 600,000 is 1.4 million. So now, how much interest expense do you have on a month-on-month basis, or that adding up to the whole year? So for the long-term liabilities you have, you will be paying some interest. That calculated on an annual period, okay, would be 300,000 for this company. So this company doesn't have any capital. So there is no capital equipment. There is no depreciation to it, so it is £0. On a annual basis, they pay a tax around 400,000. The total non-operating expenses, the EBITDA minus you add this interest, depreciation, and tax. So which is basically 700,000. Now your net income is your EBITDA minus this non-operating expense, which is 700,000. Is your net income, which is your net profit, I would say, which is 700,000. I hope this income statement is clear. So why do we do all this? Okay, so this is we do for us to make sure we record all the financial transactions in the company, and with this balance sheet and income statement, we can calculate different ratio to see how strong the financial health of a company is. So number one is quick ratio. So it is basically what it says is why generally we do it. So basically, how much assets can we use, or how much asset can we liquidate immediately to meet the company liabilities. So you see on the top here, these are liquidated immediately, the total current assets. Generally the total current asset minus the inventory and the AR. Because if you remember, I told you before that AR and inventory would take some time to convert it into cash. So the total current asset minus this and this, which is 10 million. So that 10 million, that divided by the total liability, which is total liability is 4.8 million. So that 10 million by 4.8 million comes around 10 million divided by current liabilities. Yeah, so not the total liabilities. So what is the short short-term liability you're responsible, which you have to pay for? Basically, which is 1.8 million. That is 10 million divided by 1.8 million comes around 5.6. Not 10 million. It is basically B8 minus B7 and minus B6. Yeah, so let's do that. B8 minus B7 minus B6. Yeah, it's 10 million. That 10 million divided by current liabilities. The current liabilities is this one, yeah. When we do that, okay, it comes as 5.5. Yeah, 10 million divided by 1.8 million. So that is 5.5. So, I mean, it is rounding off, or it is 5.6. So what this ratio says is, if this is greater than 1, that proves that the company has the money in treasury to meet short-term obligations. So if your assets are more than one time liability, then you have, if your current asset that can be quickly liquidated are more than one time of the short time liability, that is current liability, then you don't have the risk of not paying your vendors on time. So it proves that the company has the money in treasury to meet the short-term obligations. That's what this ratio says. Secondly, current ratio is here. Current ratio is basically current asset divided by current liabilities. So here the current asset is 12.2 million. That divided by current liabilities 1.8 million. So the slight difference is here we take into account even the inventory and the AR, which cannot be liquidated immediately, just to see these both are more to talk about how quickly you can pay back the short-term current liabilities for your vendors who has given you things on credit. So here it is 6.8, still good. So greater than 1. So the company has the money in treasury to meet the short term, which is pay back to the vendors where they bought the materials or whatever they bought back from the service provider. And the next one is day sales outstanding. It is basically nothing but how many days the company takes to collect the outstanding cash that has to come in to the company. So just to be clear, how many days the company takes to convert its sales to cash. It's the same definition what I said. So let's say the total AR for the company is 1.5 million. Yeah. So that 1.5 million, we have to see how many days the company takes to get it back. So the way you do it is you take your total AR, that divided by total sales, multiply by 365. I think so I have given the total AR value here as wrong. Total AR is 1.5 million. So it has to be 1.5 million divided by total sales. Sales is 15 million. Okay. So if you notice, that is B6 divided by E4. That is this one, E4, multiplied by 360. Right. So it takes, on an average, the company takes 36 days to collect the cash for the product they've supplied to their customer. So industry average is anything between 30 to 45 days is good. But the lesser the days you take to collect your cash, it is better for the company, because you're getting back the money sooner, which you can use it for other things which we want to do within the company. So this is about the liquidity ratio. Now going back to the solvency ratio, this is more on the debt you use within the company to run your company, or are you using the money you have within your hand, or the cash flow, or the shareholders' equity, or are you using debt to run the company? So the first one is the debt to equity ratio. which is the total liability divided by equity. Your total liability is 4.8 million. The equity is 9.4 million. The value is 0.5. So then the company uses 0.5x more debt, which is nearly 50% more debt, okay, to to run the company. Basically it uses 0.5x more debt than sales. The sales is to finance a business. Higher X could be a sign of too much leverage. If this is too much higher, let's say if it is 10 as an example, which means, let's say the liability is 90 million, the equity is 9 million, which is 10 times. Basically, you're running the company with the maximum liability. So sometimes it is possible. Okay, why? Because if the interest rate is lesser, people tend to borrow more from the banks or lenders and utilize to run the company and pay less interest and gain more profit. So it depends on company to company, so how they want to run. So the next one is the interest coverage ratio. So it is defined as your earnings before income, this one earnings before interest, tax, depreciation, and amortization. So that one minus the depreciation divided by interest expense. So this is saying how much, how many times of money you have to pay back the interest. So are you in a risk of not able to pay the interest for the long-term loan you've got? So here, if you take the EBITDA minus depreciation is 1.4 million. There's EBITDA is 1.4 million. The depreciation is 0, so it is 1.4 million divided by the interest expense. Interest expense is only 300k, which is 0.3 million. So if you do the calculation, it is 4.7 times. So the money you're getting, so after your operating expense, is 4 times more you have to pay back the interest. It shows the company can cover interest payment 4.7 times over from its earning. That's what it says, yeah. So the next one is the solvency ratio, so which is calculated by your net income plus depreciation divided by your total liabilities. Your net income is 700k plus your depreciation is £0 divided by total liability. Your liability is 4.8 million. So this comes around 15%. That is 0.15. So company generally, as a rule of thumb, in the industry, it is used that if the solvency ratio is greater than 20%, it is better. So what it says is how many years it would take for you to pay back the long-term loan, which is calculated by generally 100% divided by 15%. So with this, it's around 7 years plus, I think. So what is 100% by 50%? Percent by 15%. This has to be. So it takes nearly 7 years, as I said, 6.67 years. So it's better to have it at more than 20%. So that's a industry standard, yeah. So the next thing is about the financial leverage ratio. The first one is the debt to capital ratio. It is your total debt divided by debt plus equity. Your debt is 3 million. Your long-term debt is 3 million. That divided by 3 million plus equity. This comes as 0.24, which is 25% of the capital raised. So your debt, what you're operating income on, is 24% of the capital raised. So sometimes this ratio can go up. So if it is cheaper for the company to raise capital via debt versus selling stocks. So some companies raise more debt to run the company if the interest rates are lesser, rather than selling their own stock or using their own money, they use debt to run the company. So debt to asset ratio is what is your total debt divided by total assets. The total debt is 3 million, assets is 14.2, which is coming around 0.21. So this indicates that 20% asset is financed by the debt. So 20% of the asset you own is financed by the debt you have taken. That's what it says. So it is good. So 20% it's not it's not a lot, I would say. So remaining 80% asset is owned by the equity owners. So the next one is about the asset to equity ratio. Uh, the total asset divided, it is calculated by the total asset divided by the total equity. So the calculation goes like, total asset is 14.2 million. That divided by the total equity, which is 9.4 million. That is the shareholder equity. Yeah. So the value is 1.5. So generally the rule of industry rule, standard is somewhere between 1 to 2. So if the company is making use of low interest, raising high debt, and then that is also fine. Okay, then the value will be slightly higher. So these are the standard financial ratios which every company use to see how well the company is run, how well the strength of the finance, uh, uh, financial health within the company. So the same concept, if you apply to I try to apply it to my personal living. So what I did was, I just kind of put all my current asset that can be immediately liquidated, another asset that would take some time for me to sell, and calculated the total asset and other property and land I own, and what are the current liabilities I have, which is the short-term liabilities, and the long-term liabilities I have. So I calculate the total liabilities. Now my current net worth is total asset minus liability, which is around 54,000 pounds. So likewise, I've built an income statement for my month-on-month expense. So I have slightly made it in a different way. Let's say myself, I get paid this much on a month-on-month basis, and my wife gets paid this much. On top of that, what is my operating or running expenses within my household? So that I have divided into multiple different buckets. I put all my expenses to get my operating expenses to run the house. And that is total. Okay, so what is the EBITDA is your gross income minus this operating expense, is the EBITDA. Then other interest expense I have to pay on my mortgage and loan I have added here. There is no depreciation because there is no capital, capital equipment. So probably I didn't go into the depth of probably certain things I have as part of inventory can be called as capital. There'll be a depreciation value to that, but I didn't go into that. I just put it as £0. And what is the month-on-month taxes and NI I pay? Taking all these value out from the EBITDA would give me net income. So my total tax plus this is around 2,475. My EBITDA is 8,746. That minus this is 6,271, which is my total net income for the month. So likewise, I've built different ratios, how I explained, by using the same concept to see how well I'm running my personal financial health. Okay, so I put in those here, mark some red. Okay, probably I might have to do some work to make this as green. The same concept applies here. Similarly, I've built an income statement, which I use to track my expense on a month-on-month. I just keep adding those, expense and see how well am I keeping to the current kind of budget I have. So this can be further divided into line item level. Okay, so probably I'll show that in another video. So I hope this would have given you some idea about what is balance sheet, income statement, how you can use it to take some get some insight on your finances. Have a look at this if you want to download this particular template. I put it for free. I put the link below in this video. Just please feel free to go ahead and download it and use it for your own reference or own use, and make some use of it. Yeah. Thanks for listening to me. I hope the session would have been productive. Yeah. I'll see you all in another video soon.